Hey everybody, this is Jose Blasco. We are about to get started. 1 minute to go. This is a sound check, as we always do. Please go ahead and type a quick hello in the chat box. That tells me you hear me, and therefore sound is good and we are ready to get started. So please go ahead and have a quick message there on the chat box, so that way I know we are well connected. How are you, Ahmed? Good to see you, my friend. Very nice. Cool. Very nice. I'm just gonna turn on the video stream as well so I can say hi from my usual bottom right corner on the screen. Joe, good to see you. Mark, how are you? Maka, Clive, everybody, good to see you, my friends. 15 seconds to go. It's basically time to go, guys. So let's go ahead and begin our session. Very nice. 1 second, that's it. Top of the hour, time to get started. My name is Jose Blasco. Today is October 13, 2021. Options with options. I think the name says it all. We're going to be looking at the options markets and trade those options. Before we get started, I am highlighting on the upper left side of the screen the disclaimer. So please read it carefully. This is a session where we learn about trading and the markets and so on. So there is financial risk involved. What we do is for educational purposes. Make sure you read it carefully so you are well informed. And now that the disclaimer has been highlighted, I want to highlight the agenda for the day. Same routine, just like trading is about being mechanical. So kind of like the same approach to the sessions. We're going to look at the markets, understand what's happening. We're going to look at the trades that we have from the prior sessions to see how they're doing and if anything needs to be done to those trades from a management point of view. And from there, we'll move into new opportunities. It's happened many times. We'll see today that especially on the Wednesdays, we need to spend a decent amount of time on trade management, which is absolutely critical. Hopefully we can do that quickly, so at least we can have at least one trade executed in the session. But again, let's see what we find as we review those trades. And also, please feel free to interact with me anytime with any question you may have. It could be questions about what we are discussing, or it could be questions about your own trading, the use of the platform top, whatever experiences that you have gone through as you are trading on your own when you are sitting in front of your computer. Okay, so please feel free to interact. How are you, Steve? Good to see you. Very good. So time to close the introduction slide, and from there let's begin with analysis of the markets. As always, we'll look at the S&P. Okay, and what is it that we see? So as always, let's begin with the climate. So if I zoom in and we look at the climate, so what do we see? So what we see, it's second day of a confirmed down climate. We had a few days of blue, but notice that none of those dots got to become thick. Just like the blue dots we got here, none of those got to become thick. In other words, the climate was never confirmed to the upside. There was a change of climate, but it was not a heavily tradable climate. Depending on your rules, you may be that strict and basically you don't trade, okay, which is kind of like the basic approach to understanding climate and definitely thinking of keeping you safe. So now in this case, we do have a confirmed climate to the downside. Okay, but having said that, and I've said that before in prior weeks, a few weeks ago, we are now reaching candle number 2 out of what statistics suggest to be a climate of a duration of 2. And in that sense, we should see the market go back up and turn around and start moving higher anytime. Now, having said that, if you look at the 2 prior red climates that we had, as we discussed in the prior sessions, they were of a longer duration than what statistics suggested. Okay, why is that? Very likely because in the weekly time frame, I just changed the time frame in the wrong chart. In the weekly time frame, we also turn to become red. And we were in a down climate, and also it's just a coincidence. Statistics also suggest 2 is the maximum, and the current candle is 2. So in other words, if during this week the market continues going lower, it's not going to be a surprise. If on the daily time frame we get to see a little bit of an extension, instead of 2 red candles, we see 3, 4, 5. So it's not going to be something that crazy strange. But at the same time, the market is supposed to go back blue both on the weekly as well as the daily. So we should see that happen unless there is a very major change of market environment, given the recent fundamentals or whatever it is. And then we're going to see those statistics start to change. We're going to see the climate to remain red, and then we'll need to act accordingly. Okay, but at the same time, this is what we have right now. The one note of caution I have here, and that's why I would expect the climate to not to turn blue immediately. It may take a couple more days during the week or something like that. It's because when you look at the max distance, okay, currently we went to 0.30, where two standard deviations for red climates is 0.92. Okay, so notice how 0.92 is more or less here. So notice that in the prior climate, we reached that 0.92 at some point, and then we had a change of direction. Okay, but at this moment in time, we are dealing with 0.30, which is very far from 0.92. In other words, the market has spent enough time in that market condition being a down climate, but the market didn't go that far in that direction, and therefore, while based on the duration of the climate, we are now entering the time starting tomorrow where it's supposed to not to be sustainable based on probabilities. The reality is that the market should not be that exhausted when a market is falling very hard, like when it happened here, for example, or when it happened here when the market fell very, very hard. From there, you typically get to see a change in direction, because when the market not only stays in a climate for a long time, but on top of that went too far and too fast. So then when those two ingredients get together, that's when you normally see those turning points. At this moment in time, we have ingredient number one, which is the count. We've been in this climate for 2 candles out of 2, so the climate should change soon, but the price didn't go that far. So in that sense, the climate could continue going lower. So again, the approach for our portfolio is the same as the prior weeks. Cautiousness, management of risk, that's every day for traders, okay? So I don't need to say it. What I mean cautiousness is more than ever, you want to be skeptical about the new trades you enter, and ideally every time you enter trades, you have hedges, okay? The last session that we did last week, if I'm not mistaken, we entered a hedging trade to the downside, okay? We never enter one to the upside, we enter one to the downside. So the idea is to try to offset your trades as much as possible in a market condition which is not that well defined with so many contradictions. Talking about contradiction, the implied volatility. So the blue line is above the gray line. So from an options point of view, what we see happening from behind the scenes is a bullish bias, okay? Now the difference, if you look at the values to be precise, we got 16 versus 1557. So it's not like there is that much difference, okay? So it's a very, very tight fight, if you wish, between the buyers and the sellers, and it's not too clear yet at this moment in time of what's going to happen. When we look at the options volume map, we can see more puts than calls traded, okay? But the call volume is above the average, where the put volume is not above the average. So again, another contradiction. So we see contradictions all over the place, and that is the sign of indecision. And the reason why there is indecision is because probably many more professionals are doing the same type of analysis I am doing right now. And, as you can see, it's not crystal clear. It's not an easy climate like we've had, for weeks and weeks and weeks and months ago, before, a couple of weeks or 3 weeks ago, where the market, started changing direction in a way that was not predictable based on probabilities, okay? So we need to remain with this additional cautious approach to trading, always ready and happy to get some hedges in to protect our portfolio overall, okay? And later when we review the positions, I'll make an additional comment to that when it comes to the type of positions to build as a hedge, because hedge is not only directional, okay? We also need to hedge the Vega exposure and so on. So I'll talk about that in a moment. Okay, what else? The VIX. So when looking at the VIX is currently trading at 19 point something, okay? So 19 point something. So again, it's a bit far from the green, a bit far from the red. So, again, another place where we don't know too much what to expect. And to be honest, when you look at these candles, okay, if you were a classical or technical chartist and you were to look at candlestick formations, all those candles represent indecision. So it's 4 days in a row where from an implied volatility point of view, the prices of the options are basically going nowhere, okay, ranging between 21 and 18, right? So in a tight range of implied volatility. So yeah, we can see what I just explained from the S&P itself as well as from the VIX. We can conclude the same thing, okay? So ideally, if I had time, my choice today would be to find a long, to find a short, and to find a non-directional trade and put them all in the account as long as it's compatible with the other trades I may have. So if the market starts moving, I start making money. If the market continues not really doing something too clear, so then the non-directional trades are going to help the directional trades that are going nowhere. Okay. So anyway, that's the analysis of the market. Feel free to comment if you have any comment or question, and I'll take a look at the chat box in just a moment. Now, when it comes to reviewing the positions that we have, so we're going to start with Intel, okay? And the last tweak that we did with Intel was to convert Intel into an iron butterfly, okay? So if I was to look at Intel, right, and I was to move, I believe we planned this trade on a 2-day time frame. Yes. So notice what happened to this trade, okay? So initially it worked very well as we entered this position, right? But then when it reached the opposing purple area, the speed bump, it went very aggressively on the opposite direction, okay? So actually even a red UFO now showed up, okay? So in other words, it's extremely likely that this trade will not do too good for the account. But the beauty is that this trade cannot hurt that much either, okay? You can see this trade is producing a PNL of minus 47, but the reality is that the PNL of this trade is much better than that because we collected prior profits before. So remember that this trade was going to end up in a profit no matter what, okay? So there is not much more to be done here, okay? Not much more to be done with Intel. The only thing to consider is, we are short the 57 call. This call is trading at 0.05, okay? So, when we sold it, we collected 12. It's currently trading at 0.05. If that call was sold at a higher level of premium, then it would be great to basically close it, okay? And that's it. Typically, it's a pretty good idea, especially if you use a broker like TOS, where they don't charge commissions for closing orders for 5 cents or less. So it's a pretty good idea to close short options trades that we have in the account at 5 cents or less. Now, because we only got 12 cents when we did this trade, so now closing it at 5 cents means that the maximum profit you'll make now is 7 instead of 12. And on top of that, you need to pay commission for that. So I would say we're just going to leave it alone, like full, leaving it alone with nothing else to be done. Okay, so that's the plan for Intel. The expiration date, by the way, it's October 15. So very likely this trade will end up with, just a little tiny above breaking even, which was the plan of the trade as we kept tweaking it after Intel treated us very well at the beginning and then became very disappointing without continuing the move towards our target located at 58, okay? So that's all I have to say about Intel. The next one is ADM. ADM, if you recall ADM right here, okay? So ADM was a trade that was entered. You can see here the PNL for Intel at the moment. The net PNL is 0.5, okay? So the net PNL for ADM right now is actually it's not 42. It's better than that. I'm noticing that I did not do something here, did it? Or did I? Let me see. Okay, I'm going to review that in a moment. Let me take a look at the chart first. So the chart, if you remember, we entered this trade as a hedge. It was a short hedge. We were expecting that stock to fall. Notice how that stock, instead of falling, that stock just went parabolic to the upside. So it did not work as a hedge at all. But remember as well that we went ahead and we closed this trade. We entered 33 shares of stock against this trade. So we hedged the hedge with shares of stock, okay? And let me go back to what we have in the account now. So if you look at ADM, the only thing we have in the account now is a put. And when you look at this put is showing a PNL of minus 167. This is what the put shows, okay? A PNL of minus 167. But the reality is that we closed the other units. Let me bring the position back. So we closed the prior unit. So the initial hedge was hedged with 33 shares of stocks, exactly. And yeah, that's the problem, that I still have those 63 shares of stock there. 33 shares of stock, which I guess I forgot when we did this change. I forgot to update this. Yes, I did forget, but really the real P&L of the trade, let me update it. That's my mistake. I should have done that. So what we did last week is that we closed this trade when the stock was trading at 64 something, I believe it was. Let me see if I can get back that price. So field orders, this is account statement, here we go. So profits and losses by symbol. Okay, so with ADM, no, not here, sorry guys. Normally I look at my fields on the website, actually, on the website of TOS, not here. I remember there was a way on how to, just give me 1 second, guys. Should be able to find this. Field orders, field prices. I kind of forgot where it was. This is what I have now. Sorry, guys. I'm positive there was a place easy to find. Not account summary, profit and losses, by symbol, by account, overall. That's not what it is. That's not what it is. Okay, I forgot. If anyone remembers, guys, it would be great if you could share that with me. It would be great because I don't remember, and my bad, I did not document this the way I normally do. But in any case, I'll just explain it because, to be honest, this trade concludes on Friday, so it's not like we're going to do anything else with it. And if you were here last week in the session, so you saw it, even though, again, unfortunately, I did not document that one properly. But basically, we closed everything else that we had, okay, including the shares, and we are now left with the 60 put. So what happens is that the 55 put that we had sold at 15 was closed for whatever price, and therefore a profit was made. And the shares that were filled at 60.30 were sold at, let's say, 64, so also another profit was made. So in other words, now you are left with a put that cost you 172 and the market went up, so you're going to lose the whole 172. But while you're going to lose the whole 172, you collected profits on the shares and the puts and the 55 put that you bought back. So in other words, you are now left with a very, very little amount of pain. And the beauty of having that 60 put in place is that if the market was going to fall hard, so next thing you know, this hedge would actually work even better than before. Okay, but the fact is that the market went up to 63. So again, that put will be lost. But again, the overall P&L of this trade is indeed, either a small profit or a small loss. I'm not sure at the moment because I did not document it properly. Okay, but basically, it was a good management from the point of view of turning a hedge that didn't behave as we wanted into either a break even or a bit better, or break even or a bit worse position. Okay. So anyway, but again, October 15 is there, so we're gonna leave it alone. Colgate Palmolive. Okay, so let me see if I got the right P&L here. So it says minus 104. Okay, and this together with Pfizer. Okay, let me review those two at the same time because in the end, those two is kind of like the same story. So if I look at CL, okay, so we were doing this trade because there were UFOs and there was the speed bump, and we were expecting this to move up. Hasn't happened. Okay, has not happened. So it tried to, but didn't work. So it's a little bit of a fight, and of course it makes sense because the whole S&P is going down. So that stock, is having a tough time to go up because we know stocks are fragile, right? They depend on the industry, on the S&P, on competing companies, etc., etc. Okay, so it's a matter of patience at this moment in time with this trade to either end up losing what we were expecting to lose, or start having the move happen, and then we're going to start managing the trade. And with Pfizer, it's similar. Okay, it's similar. we went in here and then it moved against. So it's a similar story. Again, why? Same story, the S&P. But with that one, when we looked at it, we were able to manage to do a different type of play. Okay, so if I was to analyze what is it that we have with Pfizer, it's more complex. So what we have, we have a Barefoot Spread. Okay, we have a Barefoot Spread where we sold the 42 and we bought we sold the 43 and we bought the 42 put. We have two of those. Those were used to buy the 49 call. Okay, those were used to buy the 49 call, if I'm not mistaken, or no, wait a minute, the 47 call. And what we did the other day is that we went ahead and we sold two of the 48 and we bought one of the 49. So in other words, we are now in a place where we have two bull put spreads paying for one directional butterfly. That's what we have. The puts are paying for the calls. The call is a directional butterfly and the puts are bull put spread, and we have two of those. Okay, so that's what we have. So in other words, this has a positive delta, and if the stock rallies, then we're going to start making money. Okay, but we are not going to start making money unless we reach 43 or higher. And that stock, it keeps falling to 41. So we indeed need that stock to start going back up. Okay, so if the S&P moves back up, we will, I would say, likely get to 43. One standard deviation is 44.5. So if the S&P starts moving higher, we should be able to get back to this green zone and end up basically saving this trade, that instead of a loss, this trade will end up as a profit. In the meantime, by doing the tweak that we did the other week, we also reduced the risk of the trade a little bit, okay? To instead of, like, I think it was $200, so the risk of the trade became, as you can see, 186, okay? So that's what we did last week, and there is nothing to be done here, nothing to be done. I mean, you could go ahead and close the 48 calls for 5 cents if you want and try to get that, but we only got 12 cents. So again, just like what I explained earlier concerning the other trade, closing them at 5 cents in this case, to me, it doesn't make sense, okay? So because of the little amount of premium collected, okay? So we have it there, and then we just leave it alone. The next one is KBH, okay? And this one is a little bit of a naughty one. Why? It's another hedge that we entered last week, okay? KBH, okay? And look at that. While the S&P is falling today, that stock is moving higher by 1.42%, okay? So this is quite, let's say Murphy's Law, let's say, let's have a smile, something like that. Because you can even see that on the put side there is much more put buying than call buying. So everything is bearish here, okay? Everything is bearish, but the stock is doing its thing and moving higher. So I guess maybe we're gonna have to wait until the stock rallies a bit higher to 39 something, and from there take the trade. Now, fair enough, okay? Fair enough that this and by the way, this was a hedging trade. So we were not precise with the timing and the entry. We entered right there, okay? If we did what we normally do, which is to wait for the stock to go back to where the average is, find a UFO there and then take the trade, then initially we would have been in a profit. You could have managed the trade a little bit, and now if it's moving against you, that would not be so much of a problem. But the thing is that we entered because it was a hedge, and you don't want to miss a hedge, right? And with the hedges, because they are hedges, it's okay to be less precise with the timing. So we have two ways on how to enter hedges, which is either using the UFOs, that's the perfect entry, but not always available, or we use the 8-minute time frame. Wait a minute, I just slided it there. So we use the 8-minute time frame right here. And what we did the other week is what they said is, look, if price goes below this line, take the trade. But at the same time, we also had an Elliott wave indication somewhere here on the left, and therefore we took the trade because of that. So the stock went against us and finally started going our way, and now it's teasing us again. Okay, so we are just gonna let it do its thing, because if the S&P goes up, then Colgate Palmolive, Pfizer, all those trades will do well. So we'll be okay with the hedge going against us because we have other longs. If the market falls harder, because today it's going down but not by too much, so probably that stock, which belongs to a weak industry, will follow through, and then the hedge will start working. Okay, but again, funny one, similar to ADM actually, that when we enter the trade, it's been teasing us, and actually not even clearly, because so far it's going sideways. It's not even going up against. It went down actually, but then it went up again. So if you had looked at that 2 days ago, it was in a little bit of a profit. It was below our entry, but now it's back into losing a little bit, tiny, but that's what we have. Okay, so again, patience. Sometimes we need patience, and this is one of those cases. And finally, Twitter, which is an Aaron Condor. It's currently showing $21.50 of profit. So if we look at Twitter, and Twitter is actually a very easy one to analyze, because you will see there is nothing to be done. I've been watching this trade, and there is nothing to be done. So as you can see, the current price is right there in the middle of the purple area. The probability lines are showing that we are very likely going to end up in the purple area, and therefore it's all good. Okay, so we just need to let time pass, and of course, if that stock was to start moving aggressively against us, so we would then need to start doing our tweaks, which is, by the way, a long time that we haven't, because we are loaded on directional positions and not so loaded on non-directional positions, which is exactly the point I wanted to bring in earlier when I was doing the market analysis. And I said later, when I do the analysis of the positions, I'll make a point, which is, if you look at this account, okay, and again, this is an account where, what I got in there is whatever I have time to do when we are together in the sessions. So of course, the account is lacking on positions and lacking on more than positions when it comes to numbers. What the account is lacking as well is on positions that are needed. Okay, so for example, in here, everything, ADM, CL, Intel, KBH, Pfizer, all of this is directional, and all of this is losing time decay, $4, $2, 4 cents, actually 4 cents of profit in this case, of positive theta, -1 and -15 cents. So everything is suffering time decay, and the only position that is not is the Twitter non-directional trade, which is an Aaron Condor, which is making $5 a day on time decay. So that's the other concept when we talk about hedging. It's commonly, and maybe I could phrase it better in future sessions, but normally when most traders talk about hedging, the assumption, or the majority of traders, are thinking about either being directional long or short. That's kind of like what most people would think about. When I'm talking about hedging, I'm actually talking about the delta, the theta, and the vega. So notice what happens to the vega as well if I add the vega here. Let me get the vega. Actually, right here. So I'm going to add the vega, and I'm going to put it right next to the theta, actually above the theta. Here we go. So notice what's happening. I am positive vega. Okay, I am positive vega because all my directional trades are positive vega. The only one which is negative vega is my Aaron Condor, right? And the opposite happens on the theta column. My Aaron Condor is positive theta, where all the directional trades are negative theta, right? So in other words, I am not well balanced. In a perfect world, my vega exposure overall will be closer to 0, and my theta exposure overall will be either closer to 0 or, in a perfect world, positive, because theta is a sure thing if it's positive, right? The time decay pays you for sure if it's positive. So in a perfect world, you got directional positions and non-directional positions all combined producing positive theta. So, the portfolio overall, I mean, it's not a big deal. We have so many positions and it's only showing negative 474. So given the fact that most are long positions and the market has been going down for multiple weeks, you can see the beauty of options trading and the tweaks that we have done. None of those positions is killing us, okay? But if I had, instead of spend 2 days a week, okay, and this is what you guys need to be thinking for yourself, because you are available to be in front of your computers every day of the week, right? So if instead of spending 2 hours in a week together to put positions in, I was to look at the market, let's say 1 or 2 hours a day, and I was to add whatever it is that I need every day, So I would be able to manage my Vega and Theta exposure better. Apart from the Delta exposure, I would be able to manage my Vega and my Theta exposure better. And therefore, that P&L now would show much better. Because if you think about it, really, if you look at the S&P, okay, so they have been moves to the downside pretty cool. And I have not capitalized on any of them. The most I did is to enter a couple of hedges to the downside, and those hedges have been a little bit rebel, not really moving in the direction I wanted. So I have not been able to capitalize on this well. So if I had entered a few more shorts, I would have, and I would have locked in some profits, and I would be in. Same, not on long positions, because basically I've never been in a confirmed blue climate, right? So I mean, you could have entered some long position with strong stocks that belong to strong industry, but probably not that many, because the S&P was red most of the time, right? So that's what I've been basically teaching you in prior sessions. So you would still have few of the longs, you would have a few more of the shorts, but in the meantime, you would also have non-directional trades, and that would pay nicely because volatility went up in the past weeks. And if you think about the range, the S&P has been ranging from, let's say, 427 to 444, which is kind of a sideways market. If I was to draw a box here, it's kind of a sideways market. So if you had 2-3 more iron condors, those would have paid. Some may have expired already. If you had 2-3 more shorts, maybe one more long or two more longs, so those shorts would have paid. And as the market picks up to the upside, all your longs are gonna, make a lot of money for the account. So again, it's important to keep that in mind when it comes to thinking of your portfolio overall, and enter the positions that you need. Okay. So based on this, okay, the greatest urgency for this portfolio really would be to enter non-directional trades. Okay, another iron condor. That's urgent. Why? Because I got too much negative theta, and on top of that, I got too much positive Vega. If I enter another iron condor, okay, so let's say I can do the same again, minus 2.5 and 5.6, 5.06. So that minus 0.23 is going to become flat. So now you don't suffer time decay. And if I add another 2.5, so this Vega exposure is going to be half. Okay, and that's how you manage and balance out the various Greeks that affect your portfolio, apart from the directional ones, okay, which the delta here, you really care, you really only care about the delta from the directional trades, and basically the S&P will be your guide there on when to enter more long than shorts and when to enter more shorts than long, okay, depending on the market conditions overall. Anyway, long explanation. It's 30 minutes after the top of the hour, so it's time to get into planning trades. Let me take a look at the chat box. There is a little bit of typing there. I should have looked at this before. Mark, order history and cash and sweep vehicles and trade history are missing from your account statement window on TOS. Yeah, so maybe that's what it is, because I mean, this is just a simulated account I use for the sessions. Maybe so that's why I have the muscle memory on my other login and password, that I do have that. So that's that. Maybe it is. Got you, Mark. Yes. I remember what we did. It's just unfortunate that I did not document it for that trade. What trade was that? It was the ADM, I believe it was. Yes, I think it was the ADM, correct. Good. Okay. So hey, time to look for trades. I will have a sip of water, if that's okay, and we go for it. Very good. So we said we're going to be looking for non-directional trades given what I have in the portfolio at this moment in time. Okay, so we go to the metrics, and I'm going to start looking at the various settings that are needed for this type of trade. So first thing, in a perfect world, we want to find options that are very pricey. So we're going to start with IV mean greater than 80. Then we'll make the second scan to be known for now. When it comes to group rotation and strength, we're going to uncheck everything. We don't need it. Options filters, we don't need it. We're going to be importing the list I normally use, the penny increment options. Here we go. From a strength point of view, we're going to be looking at the daily time frame to be neutral and the weekly time frame to be neutral. From earnings point of view, we want to exclude at least the next 10 days. And then for auto climate, we just want to uncheck. We don't need anything related to climate at this moment. So if we scan for that, let's see if we get something. It seems that we get 4 potential opportunities. So let's go ahead and take a look. Okay, so today is October 13. We got earnings on the 29, 26, and then on November 3. Okay, so I think that all looks good. So let's go ahead and let's go from top to bottom, and let's begin with ABBV to see what that stock has to provide for us. So let's begin with ABBV. Okay, and so here's the chart. The earnings date, it's happening on 10/29. 10/29 happens to be the expiration date. So if we do the trade with ABBV, the most we can use is 10/22. Okay, the 22nd of October. And by the way, you guys are very, very silent out there. I'm sure you are focused on working with me in parallel with maybe your other computer screen and replicating and looking for the trades, which is the way to do it. But if that's okay, because it's been lots of silence on the chat box for a while now, give me a quick all good, a quick all okay, whatever you want to type, just so I know you guys are with me and you're following and it's all good. So anyway, so 10/22, okay, it's the maximum expiration date we can use because the next one is not valid given the fact that that's when options expire, okay? That's when earnings take place, which is the same day as expiration. I meant to say. So we're gonna be loading the spread select. I'm gonna be floating it. We're gonna look at ABBV. Okay, we are going to select a short iron condor. This is what we're gonna start building. Okay. And as we are building a short iron condor, we're going to select the expiration date to be October 22nd. It's basically the only one we can use. So that's going to be just one try, one expiration date only. And we're going to start with a current strike. Not sure why it showed at 105. The current price is 108. So I'm going to go for 108 at the money strike. And then with that expiration date, the minimum strike price increment is 1. The maximum, this is a $100 stock, so I'm gonna go for 5, so 1 to 5. And with all of this, I am also going to load the filters with the template that we use for iron condors. So iron condor preferred parameters. Notice when I click OK, we get this text here, iron condor preferred parameters, show right here. So the filter is loaded. Okay, so far everything fails, as you can see on the column on the right. So now it's time to produce many more of those. So 99, that's the number. And now we're gonna click and sort the filter column, and we got 3 passes. Okay, so let's see if those 3 passes actually pass or they don't. Steve, all good. Ahmed, all good. Clive, going fine. Wonderful. Thanks for your feedback, my friends. So now, the ones that pass have a break-even point going from 124 to 101, 102 is the best. So let's go ahead and look at the chart using that date of October 22nd. Notice the red line is the one beyond all the lines, and this is showing us 113 to 102. Okay, let's call it 114. So 114 to 102, and here we got 124 to 102. 102 is fine, but 124, I'm not clear on that, and I'm just gonna discard it immediately because I am just noticing here that they are missing quotes, okay, which means that certain options have not been traded, and then this is distorting the calculation. That's why we got this 124 value, and on top of that it shows potential lack of liquidity, and that's not gonna be good. Okay, so we are just gonna go ahead and pass on that. Yeah, it's a shame, but it's not gonna work for us. I'm just looking at other strikes below, but yeah, no good. Yeah, no good. You look at strikes like the 114, it only has 8 cents of bid. The filter, it's filtering for minimum 35 cents. So it's not gonna work. So anyway, so let's go back for the next one, and the next one in the list was electronic arts. So I'm just clicking on this one. We're looking at the chart. Okay, notice in this case the implied volatility it's actually within the blue line. Okay, so the blue line, the historic volatility actually suggests a wider range than what the implied volatility is providing. Okay, yeah, quotes are missing, always a bad sign. You never know if it's a bad tick or it's a problem. So we just pass when we don't have clear visibility. So let's go ahead and do the same with electronic arts. So I'm just gonna load EA. Okay, and also we need to look at the earnings date. The earnings date was on November 3. So then the maximum expression that we can use is going to be 1029. So we're going to be using 1029 and 22nd. Okay, so those are going to be the two expression dates that we're going to experiment with. So 22nd and 29. November 5 cannot be because earnings is happening before that. This is a $100+ stock. It seems that the minimum range is 1. The maximum range, I'm just going to move it up to 5. Okay, we got Iron Condor preferences right there. So this is good. So then it's time for me to build 99 of those Iron Condors. Okay, and see what passes and what doesn't. Okay, we have a bunch of pass. Okay, with October 22nd already a bunch of pass. Okay, so okay, so let's take a look at what is the upper part for October 22nd. So for October 22nd, I'm looking at the light blue. We are talking about 146 to 124. Okay, that will be the size of the range. So 146 to 124. Here we got 144. Okay, 144 to 115. Okay, so that would pass. 147 to 115. Let me, sorry, guys, I need to go back and revisit this. 147. Yeah, so 147. And the bottom part, I said 125. Got it. So this would be okay. Let me take a look at my filters here, one sec. I got the midpoint to be 35. Got it. Cool. Okay, so we got, yeah, but I'm just not happy, guys, because I'm just looking at the liquidity on the October 22nd, and that's why I'm just going back and forth to try to find a solution for the trade. I'm just not liking it. So the bid price is, as you can see, 10 cents, 25 cents. The ask is $1.15. So there is almost a $1 spread there. So, and I see that all over the place when looking at the October 22nd. Okay, so I'm gonna give this trade an opportunity to work for us using October 29. But with October 22nd, I'm not happy with the liquidity we can see. Okay, so I'm just gonna uncheck October 29 with those very wide spreads and build new 99 spreads and resort that using October 29, and let's see if we're gonna get a better liquidity or not. And well, yeah, I'm not happy either. I mean, it's better, 98 to 135. Yeah, I'm not happy, guys. Not happy. So let's continue. F5 networks. So let's take a look at this one. Earnings with this one is happening on the 26th. So we're going to use the 22nd. So let's do FFIV. FFIV. And we just said we're going to use the 22nd, not the 29. And this is a $200 stock. So the minimum we have is 2.5, and I'm gonna go ahead all the way to 10. I'm okay with that. Okay, so let's build 99 condors. And let's sort to see what passes and what doesn't. We have a bunch that pass using October 22nd. Yeah, we got missing quotes in a bunch of places there. So the bid and the ask, 35 cents to 155. I'm not liking it. So let's take a look at Visa. We're gonna look at Visa. Visa has earnings on the 26th as well. So we're gonna use October 22nd. So Visa, load October 22nd, I have it there. $200 stock, the minimum is 2.5. We're gonna go all the way to 10. And we're gonna create 99. And let's see if any of those condors passes. So we can look into them further. There is a bunch that pass using on the 22nd. We do have much better liquidity here, 112, 118, 40, 46, 65, 73. This is so much neater. So let's take a look at the chart and see what the statistical range would be for the 22nd, which is right here. Okay, so the red line is the one which is the widest. So we are looking at 232 versus 211. Okay, 232 versus 211. For me, top mean range is 5, not like you, Jose. Oh, okay, got you. Perfect. So I said 232, 211. Okay, so let's see if we got 232, 228, 229, 230, 231, 233. Okay, so we got a 233 and 214. We said 211. So it's not going to work. Just by a little tiny bit, but it's not going to work. Yeah, it will not work. Just by a bit, tiny bit, but it doesn't work. Okay. Yeah, in cases like that, to be honest, I won't do it, okay? But just for you to know, in cases like that, if you were to look for return on investment to be maybe a little less, maybe like 20% instead of 25 or something like that, you may get it, okay? You may get it because it's so close that you may get it. But again, I'm just sharing this so you guys know. So anyway, so we got our list of first initial 4 symbols. It's been a no. So we're gonna look for more opportunities by switching the method used to find the opportunities. Okay, so we use method number 1, which is the range, the mean greater than 80. Second method is going to be mean minus historic above 2 standard deviations. So let's see if we get any symbol like that, and we got 2 new symbols, ANF and Royal Caribbean. Earnings date November 23 and November 4. So this is a longer expiration date. So let's see if that's going to work or not. So let's take a look at ANF. Again, earning on November 23. So we can go as far as November 19. That's how far we can go. Okay, so ANF. We can go as far as November 19. So we're going to check mark all those various expiration dates. Okay, and we're going to start with, this is a $38 stock. So I'm just going to go $1 to maximum $2. That's it. It's a very cheap stock. So let's go ahead and let's plan on 99 spreads and see what happens. So filtering using October 29. With October 22, we got nothing. So with October 29, it may work. So let's take a look at October 29 right there and see what the statistical ranges are. Notice, I think the blue line is further away. So 43, 73, and 33.08. So 33.08, yes, those are the greatest values. So almost 44 and 33. So with that in mind, do we have almost 44? We have almost 44. And we got kind of 33. Oh, wait a minute. This is November 5. Okay, so this is November 5, so it doesn't work. Okay, so then let's redo our analysis without October 22nd and November 29. Okay, so let's redo this. Let's build new 99. Okay, and let's resort and see what November 5 provides us with. I would say not good because all the values are 42, 43. November 5 needs to be greater values. And also with November 12, 42, 43, I don't see anything larger with November 12. And with November 19, I see 42, 44. Yeah, so I don't know, maybe 45 is going to work. Let's take a look. And November 19, no, it doesn't work because it needs to be 46. So there is not enough premium with ANF at the moment. So the next one in the list was Royal Caribbean. It's a $87 stock that may have a little bit more juice in it. Let's see. So let's restart our analysis with Royal Caribbean. You guys follow? Am I going too fast? Is it okay? Let me know, please. So with Royal Caribbean, we have earnings date on November 4. So earnings maximum is October 29. So I'm going to readjust my dates. 22 and 29 is okay. 5, 12, and 19 is not okay. And I'm going to go ahead and this is an $87 stock. So I'm going to go from minimum is what? 50 cents. I'm just going to start with 1. I don't think 50 cents will work. And I'm going to go for 5. So let's take a look. And let's build 99. And let's sort and see what we've got. So with October 22nd, we got a bunch. So let's find out what is the statistical range on October 22nd, which is here. Notice how the red line is the one which is the furthest away, above and below. So therefore, we are looking for 94.5 and 80 something. So 94.5 and 80 something, 90, 91, 90, 90, 92, 93 and 6, 93, 6, 91, 92.5, 93.47. Many meet the rules, 94.3. Oh, but this is October 29. Okay, so yeah, so many meet the rules, but the rules to pass the filter, but the break-even is not good enough. If we use October 29, break-even needs to be 96.7 or 77.8. So 96.7. It's not looking like we're gonna have enough premium there. 93, 96.3. I could take that. And then the bottom part we said was going to be 77.8, 77.6. Okay, so it seems that we could take that one. So yeah, so we may have a trade here with Royal Caribbean. Okay, so let's go ahead and clear the screen a little bit. I'm just gonna leave October 29 only, rebuild 99 spreads. Okay, update, sort again. Okay, and redo my analysis. Okay, so again, I don't want to speed up and then make a mistake. So 1029, it's 96.7 and 77.8. Okay, so 96.7, 77.8. So I'm looking down, we got 95, looking down, we got 90 something, going down, we got 96. Okay, 96 and 79. 79 is not good. Coming down, coming down, coming down, coming down, coming down. We got, where was it? We saw it before. 96, 96, 96.3 and 77. So this one could pass. Okay, I'm just gonna open a risk graph so then I can come back and assess and reconfirm I got this right. 97 and 79. 97 is good, but 79 is more than 77, so that's not good. 96 and 80, that's not good. 92, 93, 94, 97, and 80. 80 is not good. That's not good. And then all of this is fell. So yeah, so it seems that we have one that may work. Let me double check one last time. So if I point at October 29, let me move this down. So if we point at October 29 right there, so the break even would be 96.4, 96.5 and 77 something. We can see here the break even is 96.3 and 77.6. Okay, so we are almost there. It's very, very close. It's the best it can get. So in other words, this Condor meets all our rules from the filter, plus the break-even points are adequate. Okay, so with that said, okay, now before we put the trade in place, we are going to be looking at those UFOs and complete the planning of the trade. Let me see. Mark following fine. Mark, I'm ready to write down the individual step. Joe, the upside of not finding suitable trade is repetition of the process. Yes, you're right. I love you being positive. Between us, I hate it because I wish I could be quick at the speed of the light when we do the sessions, because we only spend 1 hour together. So I can have more trades for you guys, but in the end, the market is the boss. So we also need to respect that. So I appreciate your approach, and to be honest, it's exactly what it is. So this is the upper part of the statistical range. This is the bottom part of the statistical range. Okay, so now we're going to move to the 55-minute time frame and check the probability of the UFOs, which is 48, which is good because we need 48 or more. And now we need to find 2 UFOs above and 2 UFOs below. Okay, and it seems pretty clear. The 2 UFOs below, the one below is that one. Okay, that's the one because we have 1, 2, and this is number 3, and the one above is 1 and 2. So this is good enough. I mean, if we rely on this one, we are not exactly centered. We are just a little bit closer to the upper part of the range and the bottom part of the range. Okay, even though it's okay, but I would like to do just a bit more analysis to find out if maybe we can find something else on the left. Okay, so there should be more on the left. Okay, so let me go ahead and load an 89-minute time frame instead of a 55. So data is being downloaded. So please, let's be patient with me here for a moment. With the 89-minute time, we got 46%, so that's not good. So we're gonna go for the next one, 144. Do we have anything above? No. What about we go for the 233? And I'm just thinking that maybe just by loading more candles on the 55-minute time frame, which was the original one I was using, this could have been enough to find the UFO. So let me try that, because I believe that this may be a better choice. So I am loading 5,000 bars. So let me load, I don't know, let's say 10,000 bars. And let's see if now we have more. No, so there are simply no more UFOs above. Okay, so it seems that there is nothing else which is relevant that the app is picking up on, and therefore we are just gonna leave it the way it was. And this is gonna be the upper part of the range, and this is gonna be the bottom part of the range. And so again, if I was to go back to the daily time frame, and I was to, like I normally do, look at this upper part of the range, starting from today. Look at October 29. Okay, so basically the purple area is where we need price to be. Okay, the profitability, it's a little bit tighter than that because the break-even points are not as wide as 97 something. And again, I need to talk about this in future sessions that we'll discuss. But so far we are entering the trade basically, very close to the center point of the purple area, and therefore it's a very valid starting point, and the trade is indeed valid. Okay, so I'm just gonna put the trade in there. Let me talk about the risk first. This trade has a risk of $61 per contract. Why? Because the distance between strikes is $1. So 77 to 78 is 1, okay, or 86 to 97 is 1. Therefore, the risk is $1, but you get paid 40 cents. So you have $1 of risk, but you get paid 40 cents. So your risk is $60, or 60.5 if you add the decimal places. So again, depending on the risk you want to take, so you will need to calculate how many contracts you want to use. In my case, as always, I'll just use one contract for the practice of the order placement and so on, and you guys adjust it to your trading rules basically. So we are using October 29. Right click to sell an iron Condor. Okay, and in order to avoid mistakes, float your risk graph. Okay, go back to your trading platform, get your risk graph floating on top of your trading platform, whatever platform that is. So now you can look at the strikes, okay, and make sure that whatever is here is where you type it there, so there are no mistakes. Okay, so October 29, that's right. Then on the put side, we are selling the 78 and buying the 77. So let's adjust that. 78 and buying the 77. On the call side, we are doing 96 and 97. So selling the 96 and buying the 97. This here shows us 24 cents of credit. Here it shows to me that the midpoint is more like 40 cents. Okay, so I would suggest to go for 40 cents. Now, be careful if you get filled at 24, then your risk is not $60 per contract. Your risk is $75 per contract. So do the math properly when it comes to getting filled at the proper price. Okay, again, since it seems that we may get 40, I'm going to try with 40, and if we don't get filled immediately because it's the top of the hour, I'll just push it with whatever price just so I can execute it and manage it in future sessions for you guys. But you guys at home or in the office, as you are doing your trades, just make sure you don't rush into this and you try to negotiate your entry prices because this is very relevant. Okay, so 97, 96, 78, 79. Okay, good. So confirm and send. I'm shooting for 40 cents. It says mark 2018. That's quite surprising, but that's what it says here. And this is a simulated account with delayed data, so I believe we should be able to get better, even though it seems that there is a little bit of a wild swing on the spreads. Okay, so right now it shows us 32. So I'm going to try to rectify this to be right click, replace. I'm going to try to get 30 just so I get filled. But in your case, try to get 32 minimum. Okay, and if I don't get filled, I'll keep playing with this until I get filled. So we can work on this position in the following sessions. Okay. In the meantime, the last thing I'm going to do, which is the one I forgot to do the other day, is I'm going to right click on this position to copy to clipboard, and then I'm going to get into my positions window, scroll down, and below Twitter, this is where we're going to add our trade with Royal Caribbean, even though later I'm going to have to customize the prices I got filled at, because at the moment I have not been filled at yet. Okay, so let me try to push that a little lower. I'm just going to go for 20. Don't do these, guys. Okay, don't be so aggressive as me. That's it. I got filled at 25. Okay, that's it. So I just want to have the trade in. Okay, so that way in the future sessions, so we can work on this together. Okay, so let me float it. Let me go back to TOS. Let me go back to the positions panel on top of TOS. And now we know the 77 put I got filled at 64. So 64. We know the 78 I got filled at 77. So 77, that one I have it right. Then on the call side, I got 42 and 54. So 42 and 54. So those are the prices I got. And therefore, now I will be able to simulate this properly into the following sessions, okay? And talk about it and talk about the management. But anyway, so the trade is in. We got our non-directional trade with Royal Caribbean. Here it is, my friends. And the session is over. It's been my pleasure, as always, to spend this 1 hour with you guys. And again, tomorrow, the good news I would say is that from a trade management point of view, I don't think there will be so much more to be done to the trades, because especially many expire on October 15th. So what we discussed today, it's kind of like the end of the story. And therefore we are likely going to have more time to put the trades together and practice. Okay, so excited for tomorrow. Thank you for joining me. As always, a very special time for me to spend this time in the week with you guys. Keep up the good work. Loving some of the emails that you guys send, that show, how you are evolving and so on. And also catching up with emails. I still owe a few of you some emails, even though I did catch up with most, but I still have a few that I have not responded yet. So please bear with me on that. I'm almost there, at the edge of catching up. So thanks for your patience with me, guys. Talk to you tomorrow. See you soon. Bye-bye. Take care.